Mine. In the interest of keeping the time, I'm going to go straight ahead into Mike Murphy's presentation now. Mike and indeed John Roach are both going to talk, and John, I'll just ask you to come straight in after Mike so we have no interruptions, and then we can get down to questions and answers. So Mike and John are going to deal with Grey's Grass, Ireland's competitive advantage.
Okay. Chairman, ladies and gentlemen, well, first of all, could I thank you all for coming. Your support will send speakers and everybody who's attending on such a rotten day. And we'll say that Grey's Grass, Ireland's competitive advantage. Basically, grass to cash at low cost. And better again, lots of grass to cash at low cost. And we should be heartened by the fact, we'll say, that in Ireland, we've a very strong comparative advantage within Europe. By the way, fairly closely followed by the UK. We'll say that the western seaboard of the UK is very close to Ireland, we'll say, and in some cases as good. The basis of what I'm putting in today is pretty simple. The relative costs per kg of dry matter. If we think of grass, its direct costs is 1, silage 2.5 to 3, meal 4 to 6. When you think, we'll say that grass managed well is a superb feed. And when you think of the costs, the indirect costs associated with, we'll say, when cows are not out on grass much higher, you might well ask the question, why is this a relatively hard story to sell? And probably the reason is, we'll say, that nobody really makes much money out of a farmer doing a superb job on grass. The money goes into the farmer's pocket. But there's a big, lots of siren voices will say that trying to persuade farmers that if they do this, that or the other, nutritionists, you name it, machinery salesmen, God knows who, that it will put more farmers and money in farmers' pockets. But in practice, all you're doing is transferring money in many cases. If you move away from the grass-rich system, you're transferring money into their pockets. So it's always a valid question. What's somebody's agenda? Are they trying to put money in my pocket, that's as a farmer, or are they trying to put money in their own pocket? For the last 7 or 8 months, Con Hurley and myself have been having a look at Ireland's comparative advantage. And very simply, the conclusion is, we'll say that a high grazed grass system will deliver much lower costs and will give you will be a strong, sustainable basis for expansion. As compared to what we call a grass-poor system, that's a smaller percentage of grazed grass in the diet. And that's what I'll be trying to flesh out today. What makes sense in terms of, we'll say, when quotas come off, and what definitely does not make sense. The toxic mix. I'm suggesting, we'll say, that having a mix of high cost plus high debt makes no sense and will lead to high risk, high stress, the hardship, and in severe cases, potential bankruptcy. But I'd like to go back a little bit and just look at the one up on the left and suggest, we'll say, that high cost will be associated with a grass-poor system. Grass-poor system now being that you have a lot of other things in the diet outside of grass. And we'll say that why would anybody work harder on a low grass-based system, work harder, put in more capital into a more complicated system demanding more decisions? 95% of people tend to screw up high, complicated decision systems, putting yourself at higher risk to make less money. So I'm probably suggesting 2 things. First of all, we'll say that if you're thinking of expansion, I'd suggest get your cost base in order first. And we'll say that because if you expand from a basis of high cost and low profitability and add high debt in there, that is an extraordinarily dangerous basis on which to drive expansion and will not be resilient, robust when you hit years like 2015, which inevitably will happen. Last year at this conference, Piet Boer, the chairman of Friesland Campina, predicted, we'll say, European milk prices in the range of 25 to 45. Last year, we're up towards the top end of the scale. This year, Kevin said, that as at the moment, markets are actually returning even less than the 25 cents. And it should not come as a shock if we're coming in at a year at 25 or whatever. We know, we'll say, in an era of price volatility, there will be down years. We don't know exactly when usually, we don't know the extent of it, but it will come, and it should not be a surprise as a shock. So we should design and run our businesses to withstand those shocks. And if you look at, this is a record of the milk price, we'll say, for the last 10 years. And we basically have a choice. For years like 2009, 22.6, 2015, 25, now hopefully better than 25, but maybe, perhaps lower, somewhere like that. If we want to design a system of a grass-poor system, which will give us costs of at least 30 cents and in many cases considerably more, you will be guaranteed a loss with all the stress, the risk, etc., that's associated with that. And I'm putting it to you, it's more sensible to realise in an era of milk price volatility, let's watch the cost base, make substantial use of our comparative advantage in grass, and operate a system that will give us profitability even at a low milk price year. In practice, and if you think again, if you're using grass and you have cows designed for grass, even if the average price is 25, if you have a crossbred herd or something like that, you know, on a very high grass-based system, you're probably making 3 or 4 cents better. So you're winning on the double, lower cost plus also higher return. So you can be fairly decently profitable even in a bad year. So think of, we'll say that, 2009, 2015, we don't know when the next one will occur, but occur it will. So it's a choice. It's a choice, ladies and gentlemen, as we expand, what makes sense in terms of expanding at low risk and what definitely will put you at risk and will take money over time out of your pockets. Grass-based dairy, comparative advantage, long grazing season, produce milk cheaply, and grass-rich route, it's the road to low cost and high profit, well proven over many years in Ireland, New Zealand, any grass-based industry. Key benchmarks, I hear many people saying that they've gone as far as they can in grass, and will say that I would suggest baloney. And the couple of figures I'd throw at you, and they're very rarely mentioned, the UME of 170 to 200, that's how much grass do you grow and capture, how much grass energy do you capture via your cows per hectare. And many people who think they're doing a good job are probably at 100 to 120, and I'm suggesting the potential, if you're doing a fantastic job, is a lot closer to 170 plus. 200 will be marvellous. And got to couple that with, apart from growing a lot of grass, capture a lot of that grass, and we're suggesting a figure of 70 to 75% as directly grazed grass, percentage of the total diet. Anybody who's doing that, on average, will have profits across the cycle of plus 2,500, maybe 3,000, and we'll say that, and will do extremely well. Good years, bad years, that's the road to sustained, strong growth and profitability at low risk in your business. An 8% return on capital, we'll skip over that one. The end of quota. It's a great opportunity for Ireland and the UK to build a business at low risk, good profitability. However, while very impressed with what Kevin was outlining today, basically, when we're producing milk, it's basically a commodity, and we hope, we'll say, the degree of premiumization will be as good as it can be. But basically, if you're a producer of commodity milk, we must keep the cost base low and be the last man standing if and when there's a tough year such as 2015. Because I think this particular one, I think it's more likely to be solved on the supply side, and I think there will be attrition at European level in a way we've never seen before. Why is low cost important? Competition. And we often look at New Zealand, but I want to actually have a look at the US now. And the US is turning on the mill tap. And the reason we should be concerned about it is because the US, it is already a large mill tap, and it's potentially a lot larger. They produce 90 billion litres. 2002, 2% of milk exported. 2014, 15% of milk exported. So growing strongly. And US production costs, I would suggest, more than anything else, from a supply side, will drive, we'll say, the world milk price. Now, demand has a big impact as well, but just from the supply side. And you hear many people worried, we'll say, about, Ireland growing at 50%, that it'll shag up the market and flood the market. Put that into perspective. If we grow at 50% over 5 years, by 2020, we'll have grown by 2.7 billion litres. The US, will say, over the last number of months has been growing at 3% per month. If it grows at that for the year on 90 billion litres, that is 2.7 billion litres in 1 year. And there is perfectly possible that the US could continue doing that each year. So it's a big, big tap. And more than anybody else in terms of the world traded market, the US is the one. If it's competitive, we'll say that it can flood the world market faster than anybody else. Not New Zealand, not Europe. The US is a competitor on global markets. I spent 7 weeks in Missouri on 3 trips, we'll say that in 2014. And Irish farming inputs, and it's a point not often made, if you buy a basket of farm inputs in Ireland and buy the same baskets in Missouri, it'll cost you 1.5 times as much in Ireland as it will in, we'll say, Missouri. The UK would be much the same, more or less the same as Ireland. Living costs about 50% of Ireland, very, very cheap with grain and energy. Just give you a simple example. In terms of euro cents per litre, the last time I filled my car earlier this week, it was about 1.26. In the US, if you're doing it, it's about 47, 48 cents, euro cents a litre at the moment. That's in sterling, 37 or 38 cents. The US, it is very competitive in global dairy markets, despite the currency fluctuation, we'll say 12% appreciation. It's very, even though it's high input, because the inputs are so cheap, it's still very competitive. And I want to suggest the proposition that except for grazed grass, Ireland and the UK are comparatively high cost countries in terms of buying inputs. If you want to run a high input system, go and do it in the US, we'll say, where inputs are bloody cheap. If you want to play, we comparatively disadvantage if you run a high input system in Ireland and the UK. Instead, play to our strengths, play to a comparative advantage, which most of the world would die to have. Maximise the use of cheap grass, and let's get a lot better at it. So comparative advantage, grass to cash at low cost, very cheap protein, long grass growing season, excellent grazing skills, Moore Park, absolutely excellent research, top farmers, very, very good, great culture of sharing. We'll say if anybody's interested in learning, they can do it easily. The EBI system on cows, now the second most fertile herd in the world, and making strong progress. And compact calving, it allows supply and demand of grass feed to be matched. Done properly, it's a highly competitive, sustainable mix, we'll say that, and it's a great basis on which to expand the industry. To maximise our comparative advantage, the grass-rich route, we need low cost, well, this is what I will give you, low cost, low risk, have sustainable profitability across the cycles, Environmentally, it actually measures up very well. Animal welfare, as based on cow longevity, and I think these things will become more important, and it measures up very well on all of those things. You'll make money even in the down years of 2009, 2015. And in terms of banks will very quickly differentiate between people who are profitable all the time. And in down years when assets, cows, land may be cheaper and there may be good value to be had, if you're positioned like that, you are the person banks will back. So volatility, it may well be the friend of somebody who's a very low-cost, highly efficient business, will say that, based on the grass-rich route. Key metrics to fully exploit our comparative advantage. Now, these are the top 6. Ignore the return on capital. These are the ones, we'll say, that we sent out in the survey. And could I ask for a show of hands? How many people were able to fill in those 6 metrics? How many, if any, hands up, will say that, how many managed to fill in the whole 6 metrics? Anybody? Okay, roughly 2%. How many were able to even have a good shot at it to fill in maybe half of those metrics? Okay, approaching perhaps 40, 50%. I'll treat that, we'll say, there's a comment, we'll say, and I'll refer back to it later. So key metrics. One of them will say that you don't hear too much about, we'll say that the percentage of grazed grass in the cow's total diet across the 12 months. And I'm going to suggest that under 50%, the road to ruin and tears. Not a good place to be when you hit a year like this. 50 to 60% bread and butter, improving, but needs to get better. Plus 60% strongly improving, you're getting into much better territory. But really, it's when you get plus 70, 75 that you're really humming. 80% would be an amazing figure. And let's look at the drivers of profit. In terms of some of the slides I'm going to show now from research, our farm survey data, I'm going to interchange between New Zealand and Ireland. But the message is so consistent across both. I'm not selecting things that back, if you like, the message I'm suggesting. They are so consistent behind it. There's a universality which should give us confidence. The drivers of profit. Let's look at the costs of production first, as against production per cow. And the 0.7 as against the 0.19. How to interpret that is very simple. It is more than 3 times as important to make profits in dairying, to have low cost per unit of production. That is 3 times more important than the actual level of production per cow. Which should you focus on? Costs of production as against extra feed per cow. It's 14 times more important, the cost of production than extra feed per cow. It's so peripheral, the extra feed per cow, whether it's feed or not. We'll say that it shouldn't take 2 minutes of your working day, of your working year. So the two, will say, that really drive profits are your costs of production and your production per hectare. And your costs of production are, as I will show in a minute, are primarily driven by the percentage of grazed grass in the diet. And in terms of the second one, the production per hectare, that's primarily driven by, we'll say, that growing a lot of grass and capturing it. So the two are very important. Coming back to this again, and we'll say that really simply, what I'm suggesting is, we'll say that if you think of it, think of a cow having 100 feed units, and if 75% of them can be the really cheap units and only 25% of them expensive, think how much lower a cost base you will have than if you're 50-50 expensive, cheap feed units. This is probably the most significant slide I'm going to show, ladies and gentlemen. So let's spend a little bit of time. It's a slide, it's a Pat Dillon's slide from Moore Park. On the left-hand axis, down at the bottom, is costs of production in terms of cents per litre and it's excluding family labour, so you can add on a little bit, a few cents for that. And we'll say going up the left is higher cost. Now look at the bottom axis, the bottom line, and over on the right, that is, we'll say, very low graze grass, and over on the left is very high graze grass. But really the one to look at would be the arrows, because that's probably within the bounds, we'll say, that will be relevant to grass-based farmers in Ireland and the UK. And I draw your attention first, we'll say, to the two on the right, at 30% graze grass and 40% graze grass. And we'll say that at that level, costs of production, it's suggesting, are something in the range of 35 to 38 cents. If you're in that sort of bracket, you're going to have a very, very tough time in the 2015. We call that the grass poor route, going right on the graph, we'll say. Instead, look over and we'll say at the two arrows on the left, costs of production of around 20 cents and 24.5 cents. And we're suggesting that it makes eminent sense to drive leftwards on that graph. So I would put the proposition to you, ladies and gentlemen, in your own farm, your own business, where do you stand on that? If you're at 50%, can you drive to 60%? If you're at 60, can you drive upwards to 70? And suggesting that it greatly strengthens the business to go leftwards, and we should be extremely wary of going rightwards. So, grass rich or grass poor. Grass rich, we're suggesting, is the 70 to 80%. That is optimum. But over on the right-hand side, what drives people to being grass poor? And I've put down busy fools, and I don't want to insult people, but I do want, if anybody here is either in that situation or is thinking of making choices that'll drive you that way, I want to give you a good kick up the arse, we'll say, to sort of get you to think a little bit more. And the things that tend to drive people to the right, starting, we'll say that if we work up some of those factors at the bottom, ignore the excess machinery and the fragmentation of farms. Now that's a difficult structural issue, and it does drive up cost, and the really restructuring is the only really good answer to that one. The next two, spread calving, will say that the low fertility cows and substitution, wasting grass by feeding unnecessary meal or silage. Those two are inefficiencies, and we'll say by improving efficiencies, you'll drive left. But the main two I probably want to kind of examine today, because they're policy choices open to anybody who is now thinking of expanding their business. The first one on top, production driven, i.e. going for the high yield per cow. Now the quotas are there, let's feed our cows properly and let's express their genetic potential. 95 Northern Ireland went that route, we'll say. They're effectively quota free. Now we'll say they're feeding on average 2.45 tonnes of meal per cow. And we'll say they have a cost base. It will be a bloody brutal year in Northern Ireland this year. And you're going that route, you're driving right along that line, and I'm suggesting you're going to work harder, you're going to put more capital in. It's a more complicated system, it's higher risk, and at the end of the day, it will return lower profitability. Equally, a concern would be that the second one down, increase stocking rate by buying in feed. If you increase the stocking rate beyond the capacity of that hectare to feed those cows, just by buying in expensive feed, all you're doing is you're adding to the cost base, you're dropping profits, you're working bloody hard, going nowhere. It's the busy fool route. So I think, so I'd suggest to you again, understand where you are on that line and what can you do to move leftwards, and certainly think very hard before moving rightwards on that line. This one will say that is a Moore Park slide, Lauren Shalhoub. But exactly the same in New Zealand. On the left, we'll say that is the returns, the profit per hectare. On the right, the amount of grass consumed. And very simple relationship. The more grass you grow and capture and eat, we'll say, per hectare, you'll drive up profits. And that is true in any situation. Moore Park figure, every tonne of grass eaten, plus 161 euros per hectare. It's a big, big reward. So as of the moment, many farms now in Ireland who think they're doing a good job, say on 100 hectares just for an easy calculation, growing 13 tonnes, utilising 75%, they're actually utilising 9.75 tonnes per hectare. And I'm suggesting, we'll say, that if there's a big effort, we'll say, to shift that, really focus in on what the next session is all about, Stan Lawler and Mick O'Donovan, removing the constraints to really growing grass. There is no reason why on good land we shouldn't be targeting 17 tonnes. If you're capturing 85% of that, then we'll say that 14.45 tonnes utilised. That's 48% more utilised from the existing land base on top of what many people think is doing a good job. Is that pie in the sky? If I asked any Cork farmer or Tipperary farmer here, would you willingly swap the same amount of hectares here in Cork or Tipperary and go up to Longford? I think any farmer here from Cork or Tipperary would look at me as if I have a hole in the head. Now, could I ask somebody from Longford, not climatically favoured? Mike will say that, how much grass did you grow measured in 2014?
18,860.
18,860. Absolutely not favoured. Mike, have you regularly, and sometimes it's been externally measured, have you often gone over 17 tonnes?
Yeah, for the last 4 or 5 years, we've been over 17 tonnes.
Yeah.
And the top paddock, I know you're stuck for time, but it's worth noting. Top paddock is doing 22 tonnes,
yeah,
and the 6 paddocks over 20 tonnes.
Yeah. I want to challenge you fellas, ladies and gents. A lot of people will say that they think they're doing a good job, and we don't have a good enough measurement system to show that you're absolutely leaving an awful lot of untapped potential. I'm not saying every farm in the country can grow 17 tonnes. They can't. But I am saying a different message. Of the people I know, either in New Zealand or Ireland or the UK, who've made a concentrated effort, if they're growing eggs, over 3 or 4 years to remove the constraints, the range of improvement has varied between 2 tonnes and 6 tonnes, with an average of somewhere like 3 to 3.5 tonnes. Henry Ford once said, if you believe you can, you're right. And if you believe you can't, you're right also. I hope we'll say that your mindsets won't be your biggest single limiting factor. So what's the payoff, I'll say, that just from that situation, the same 100 hectares, now growing 975 tonnes, if you can increase it to 1445 tonnes, that's an extra 470 tonnes by 161, 75,600 euros. That year, and basically every year, now it'll vary up and down, we'll say, depending on the climatic season. Is it worth chasing? By golly, even if it's not as big a lift as that, I'd say hell yes. And the other point, if you're going to expand, aren't you a lot better to expand based on the increased profitability of getting your own act in order, and you can then safely drive on, rather than expanding on the basis of low profitability? So diamonds under our feet, grass is green gold. Why not invest in our soils to produce grass to feed our cows cheaply? By a mile our cheapest feed. And yet, Stan Lawler may well tell us, I'm sure he'll tell us a bit on this, about 90% of our soils are deficient in at least one of the 3 major nutrients. I'll just pose the question, are we crazy? So some key lessons. Grow and utilise lots of high quality grass. as measured by UME. Focus on profit per hectare, not on yield per cow. The cost of the unit of production and the production per hectare, they are the two big things that drive profits. Focus on the things that are meaningful and do not be driven by yield. Yield is vanity, profit is sanity. Be very disciplined about the price you pay for land. The very first really dear farm you buy will almost certainly be the last farm you'll ever buy. Match stocking rate with grass grown per hectare. If you're growing 13 tonnes, then a stocking rate of something like 2.2, 2.3, somewhere like that is appropriate. Don't throw that up to the stocking rate, up to 3.1, 3.2, an extra cow, growing the same amount of grass, buying an expensive feed, makes no sense. High input systems, they're toxic in a low milk price year. Bragging rights in the pub about yield, they're very good. But maybe if you're able to pay your bills comfortably and have lots of, and the business is in such a good shape that you can take the family for holidays, go skiing, go off to the beach, go off whatever you like, anytime, 2 or 3 times a year, is it a better option? Using high debt to expand in a high-cost system is extreme high risk, to be avoided like a hole in the head. So key challenge, and this is going back to the survey, the EBI, huge success, huge success. The equivalent grass measurement, hugely lacking. But given that grass is probably 5 times more important than just straight cow quality, why do we not have better measurement systems in the grass area so people can really evaluate? So that people who think they're tapped out in the grass area and say we've done as much as we can, and they're operating at about 60% to where they should be, you can really highlight it to them and we'll say that, and I think it'll drive huge change. So take home messages, grow and utilise lots of grass. Plus 170 UME is a tough, challenging target. Match stocking rate to grass grown per hectare, targeting plus 70-75% of the cow's diet is grazed grass. If you get those two right, ladies and gentlemen, then sustainable profits of plus 2,500 to 3,000 a hectare across the cycles will happen. And probably I'd suggest, in terms of as quotas go, if we barrel down the right road of the high grass system and execute very well, I think you should be very confident of your future, and you will do far, far better than high-cost farmers will say right across Europe. And finally, I just start to say to anybody who's going the expansion route, I just wish you every success, and thanks very much.